What's up, everybody? Today we're going to be talking about PMI, what it is and how to get rid of it and how to avoid it. So PMI is private mortgage insurance. You may also see it as MIP, which is the same thing. Basically what it is, it's a form of insurance that is placed on a mortgage by a bank to protect themselves in the event that you, the borrower, defaults on the loan, or basically foreclose. You don't pay the mortgage. They get to file an insurance claim and get their money back. How much money they get, I don't know, but they get reimbursed for their loss. Now, generally when someone has insurance, they pay for it for themselves. Like we have cars, I pay for my own car insurance. Even if you're renting out, the renter has to get renter insurance. But in this case, the bank makes you pay their insurance premium, which I find hilarious and kind of scammy, if you ask me. So PMI is added to non-conventional mortgages. So if you get an FHA loan or you go to your ordinary bank and you don't put 20% down and get a conventional loan, they'll tack on some PMI to that to make sure their behinds are covered. Now, some ways you can avoid PMI is to either put down a sizable down payment, put down 20%, or you can go with a bank such as Navy Federal that only requires 5% down to avoid the PMI. Now, if you have a mortgage already and you have PMI, one way to get rid of it is to refinance. But in order to do this, you need to make sure you have enough equity in your home. So the reason why they require a 20% down payment to not have PMI is because banks feel more comfortable with this 20% cushion. So let's say your house is worth $100,000 or you're buying a house for $100,000. You would need to put $20,000 down. So the bank feels like, all right, we'll go ahead and take this loan on because the house has 20% equity in it. If they do default, we could probably sell it and recoup some of our costs, if not break even. So that's why they require that sizable down payment. Now, if you bought a home and it has appreciated in value, which most people houses, if they bought them in earlier in 2018, they have some equity in them right now. You can look back and say, oh, okay, well, my house, I bought it for $100,000, but it's now worth $150,000. Even if you just been making interest-only payments, you can refinance out of that and you can get rid of your PMI. Or some people still still have second mortgages because they might have, again, not put down any money at all or didn't put down enough. You can refinance and get rid of that second mortgage, which will lower your monthly payment substantially. Now, I don't remember how much PMI costs. It's a percentage of the loan, but again, every bank is different. So you want to make sure you shop around when you're shopping for mortgages. Again, Navy Federal to me is one of the best. I don't know how quickly they move. I'm actually in the process with them now, but as far as their rates go and their conventional loans, they're pretty good. 5%, you can't beat that. And if you know someone that can get you into the Navy Federal door, I would highly recommend it if you can. Because if you could swing a 3.5% down for a FHA loan, chances are you can, swing the extra 1.5% and get you a conventional. So just a quick video. Hopefully that was helpful, and I will see you guys next time.